Once again, the Federal Reserve's unscheduled attempt to boost market sentiment backfired, investors greeting the central bank's latest intervention by reversing last Friday's rebound and then some. On Sunday night, Jerome Powell, much to the delight of his adversary and boss Donald Trump, announced a massive 100 basis points cut to the Fed's interest rates, taking them to 0 to 0.25%. Remember, only a few weeks ago they were sitting pretty at 1.5 to 1.75%. This came alongside the announcement of a $700 billion quantitative easing package designed to purchase Treasury bonds and mortgage-backed securities. Fearing the Fed's dwindling arsenal, the next step may well be negative rates, something Powell said wasn't an appropriate policy for the US economy. Investors failed to take an iota of reassurance from Sunday's actions. Just like its initial rate cut or last week's $1.5 trillion injection, the central bank's decisions have been consistently poorly received by the markets. It would be unfair, however, to pin Monday's losses solely on the Fed. The markets are also dealing with some numbers out of China scary enough to start a horror film franchise. Analysts had been expecting a 3% fall in industrial production, a 2% drop in fixed asset investment, and a 4% contraction in retail sales. Instead, the readings came in at minus 13.5%, minus 24.5%, and minus 24.5% respectively. One could argue those numbers aren't exactly surprising, and that the estimates always looked a bit suspect. However, that failed to curb the blow for investors. Combine that with a weekend full of lockdown headlines, uncertainty in the UK, and news that there are now more cases outside China than in, and it was another toxic cocktail for the markets to swallow. Looking further ahead, and ever the wild card, what Donald Trump decides to do this week will likely prove to be crucial in dictating what state the markets end up in. His declaration of a national emergency helped the Dow Jones to its greatest ever single sessions points gain last Friday, so he has got the capability to reinsure investors when he comes across as quote-unquote presidential. Any further drastic measures like the travel ban could spark another sharp sell-off, though it's unclear how far market perception has shifted in terms of what is actually seen as drastic. An expansion of the stimulus plan agreed by Congress, meanwhile, could be the thing to calm fears. In terms of data, there's the Empire State Manufacturing figure on Monday afternoon, followed by US retail sales on Tuesday, the Philly Fed Manufacturing Index on Thursday, and the existing home sales figures on Friday. There's also what is set to be a very interesting Fed meeting on Wednesday, complete with a fresh set of economic projections. Given how drastic the central bank's actions have been in the last couple of weeks, it arguably doesn't have too much left in the toolbox that it could bust out, especially since Jerome Powell seems to have poo-pooed the idea of negative rates for now, at least. And the economic projections, then, could be the thing investors most focused on in the second half of the week, especially if the Fed's latest figures show the likely significant decrease in GDP forecasts for, at the very least, 2020 and potentially going into 2021 and 2022. Beyond that, again, it's hard to see what will drive the markets higher or lower. Looking at the news headlines, it seems that there's going to be a very little chance of some miracle headline to drive things higher. It might just be a case of, sort of like we saw last week, investors deciding that markets have fallen low enough for the time being that they sort of feel tentatively willing to start buying back up equities at their multi-year, sometimes even decade lows.